Hi, my name is Andy Young, Senior Financial Planner and owner at Galecki Financial Management. I'm our firm's tax guy, and today I wanted to share some thoughts with you. The COVID-19 situation has brought a number of changes for all of us. It has also changed your 2019 and 2020 tax situation. As many of you are probably aware, there is already an automatic extension in place for the 2019 federal tax return due date. You now have to file and pay your federal taxes by July 15th, 2020. This is true for most states as well. Keep in mind that if you need additional time, you can still file for an extension up to October 15th. Since the filing deadline has been extended, you are also able to make your IRA, Roth IRA, and health savings account contributions for 2019 up to July 15th as well. For anyone that makes estimated tax payments, there have been some changes around the due dates there as well. Normally, you would have had to make payments in April, June, September, and January of the following calendar year. However, for 2020, you will have the first two payments due in July with your federal tax returns, and then the September and January payments are unchanged at the moment. Congress has also implemented a couple of changes around charitable giving as well. They passed a temporary law that will allow those that give up to $300 in cash gifts to a qualified organization the ability to deduct that as on an above-the-line basis. This means that you do not have to itemize your deductions in order to qualify for this tax break. One other item on charitable giving is that you are able to deduct up to 100% of your income for any gifts that you make to charity in 2020. Normally, you're only able to deduct up to 60% of your income for charitable giving, but specifically for 2020 and the relief efforts, Congress has changed that to allow anyone that gives away all of their income in 2020 the ability to deduct that. The CARES Act has also provided some changes surrounding IRAs, 401ks, and other retirement plans. For taxpayers that would have been subject to required minimum distributions, RMDs for short, you no longer have to take them this year. This is a one-time waiver for 2020. In the event you've already taken your RMD for the year, you may be able to recontribute those funds under the 60-day indirect rollover rules. The IRS has also waived the 10% early withdrawal penalty in certain situations. This would be specifically for anyone that has had a family member diagnosed with COVID-19, been diagnosed with COVID-19 themselves, been forced to stay at home due to their line of work, or that they cannot find childcare for their dependents, or if you're a business owner operating under reduced hours. This is good for up to $100,000 in withdrawals from retirement plans. In certain instances, you may be able to split the payment of these taxes over several calendar years as well. What does this all mean for you? Well, depending on your situation, you may be able to take advantage of some tax planning ideas. One of the first items that comes to mind is a Roth conversion. How this works is you effectively move money from your pre-tax IRA to a Roth IRA. Any converted funds will be includable in your income for 2020. However, if you're a senior that would have normally been required to take these funds out as a required minimum distribution, it may be advantageous for you to convert them to a Roth IRA instead. Even if you're under 72 and have the ability to make a Roth conversion, it's still likely a very good idea to do so, especially when the market has taken as big of a hit as it has recently. We highly recommend that you consult with your fee-only financial planner to determine how you might be able to benefit from some of these tax changes that have resulted from the coronavirus. We hope to see you soon. Until then, stay safe.